Welcome to the daily update, where I'll go over the action in the market for Thursday, June 6th, and then we'll see how things look for Friday, June 7th. A pretty sleepy day, a very low volume day. There's a lot of apprehension and waiting for the employment situation report that's coming out on Friday. So things were pretty calm in Thursday's session, but it gives us another day for our indicators to click over and see, are we looking a little more positive? Are we looking a little bit more negative? Please know that the SPX Investing Program has launched. It's free for the month of June. Here is a link to a video that you can watch about the program. Also in the description below this video and below today's daily video is a link to take you to the SPX Investing Program site, and feel free to sign up. Check things out. You do get early access to the daily videos, where otherwise you have to wait until the market closes to watch the daily video. And there's lots of other things that are available, and I'm rolling more out all of the time. So let's go back and talk about what happened, and then we'll look at some charts. We had a slightly higher open, and prices then drifted above and below the unchanged level. Not an awful lot of movement, really slow. As the day went on, prices declined. We got down to the daily pivot at 55.35, and then we rebounded going into the close, and we closed just a little bit below the unchanged level. We were down 0.02% on below average volume. We are looking more positive in the short, intermediate, and we're still positive in the long term. There are some weak areas that we want to keep an eye on, some indicators that I feel are very important that are not switching over positive yet. Doesn't mean they won't. It just means we keep an eye on those things to see if they confirm that things are looking better, or if we see weakness, these indicators could continue to go down. And it's going to be about the employment situation in Friday's session. That's really what the market is focused on, and then how everybody's going to react to that. Some comments. It was a very slow day ahead of the report that's coming out. The European Central Bank did cut rates. Even though they have some inflation concerns, they had pretty much said, we're going to go ahead and cut rates, and they followed through with that. On a short-term basis, we have our stochastics, Williams percent R, the CCI 14 and 20 that are extreme positive. Intermediate term, we have the Sean trend meter and the Chaikin oscillators getting a little bit extreme now. We're looking extreme in the long term with the 200-day simple moving average. The scenario may change after Friday's session. We'll have to see. The Fed has been leaving rates unchanged or higher for longer now, for quite a while, and they plan on continuing to do that. If there's a rate cut, possibly September, there's a chart later on that some folks are even thinking that will happen sooner. And there are some economic growth concerns, and that's what we're going to be focusing on Friday, because if the report comes in hot, that might be taken as good news. If it comes in weak, it might be taken as bad news, which is the opposite of what we've been seeing lately. The dollar was down and interest rates were also down, not by very much. We closed at 4.28% with the 10-year yield, where yesterday we were at 4.29%. We're still inverted with the yield curves. Sentiment ticked down a notch to 45, where we're neutral, where we had been at 46. We're still not trending. The ADX is positive. The green line has moved back above the red line, so we do default to positive there, but the ADX is below 20 and it's below its moving average. Our bias, I'm still keeping it positive because Thursday's session was pretty much just a sleeper, and our momentum continues to be positive. We did get the weekly jobless claims. They came in stronger than expected, and we're keeping an eye on this as well. At 229,000, they expected 216,000. Last time it was 221,000. The continuing claims came in a little bit higher at 1.792 million, where they had been at 1.790 million last time. The first quarter productivity came in up 0.2%. They expected it to be up 0.3%. Last time it was up 0.3%. The unit labor costs came in at 4%. They expected it to be at 4.7%, which is what we saw last time. The trade balance came in at minus 74.6 billion. They expected minus 76.5 billion, up, or I guess you could say down from the minus 68.6 billion that we saw last time. So here's some charts of the weekly jobless claims where they are going up. The moving average is still going down. Continuing claims drifting higher. And this is something that we're paying attention to see if there are cracks starting to emerge in the whole employment situation. This is looking at the initial claims, which are in red, the continuing claims, which are in blue, and then in Friday's session, we'll get an update of the unemployment rate. It's still below that 4% level. If it ticks up, that's going to be a headline number. The media is going to be talking about that. Politicians will be talking about it. If we can stay under that 4% level, it may not have as much of an impact. Here's a look at that same chart, just giving you more of a blow up, so it's a little easier to read. Here's the non-farm productivity and unit labor costs, where we're seeing productivity going up and costs coming down. Now, that should be taken as positive from an investor standpoint, is that companies are producing more, but it's costing less in labor for that to happen. The monthly nominal trade balance did decline. It had been coming back up, showing that there was less of a deficit with the trade balance, but now it's starting to go back down as the deficit is increasing. And this is a 3-month average. What we found on Isabel Net blog charts, these are the valuations and the percent deviation from exponential growth trend, where we're using CAPE valuations. That's the Robert Shiller method, which it's more of a smooth approach. I go over that in the weekend videos, just showing how we're getting a little out of line here when we look at the deviation versus what the price or what the valuations are at this particular time. I tend to look at this, like the reading here is 33.76, and then I compare it to the median and the mean. And stocks up 4% in May is a very good thing. Well, Carson came out with a chart before May even ended saying stocks up 5% is a good thing. Well, we ended up not being up 5%. And this is an area, I blocked it out here in red, just showing what it looks like going forward when we have a solid May, and that's from 1950 up to the present time. This is the Williams percent R, looking at it long-term in a little different way, taking the S&P 500. I use this as one of the short-term indicators. It's a little too touchy for me, but this is longer term on this chart, and it just shows a persistent overbought minus 20, which is where we're at. On the 28-month, yeah, that's pretty long, Williams percent R is bullish. So the fact that this is showing good momentum in the longer term, that's the real takeaway from this chart. The 5 largest companies. Yesterday, I talked about the 10 largest companies. They like to just switch this all around and throw charts out that people like to look at. And this is what their market cap is as a percent of the S&P 500. It's 27%. These are sector flows. The interesting thing here is we still see most of the money going into tech. Then the number of consecutive months that unemployment was beneath 4%, excuse me. And this is a long time here. We've been 27 months now. And then European banks, the quintessential value sector. Do you think the Magnificent Seven has done well? Look at the Euro stock banks. It's up 146% compared to the Magnificent Seven, which is up really a respectable 81%. And then there's these things called the granolas, and that's kind of a new coinage term that's been thrown out there. These are 11 stocks, and highlighted down here are the stocks that make that up. Then the U.S. remains the world's reserve currency. There's a lot of talk going back and forth that other currencies are starting to emerge. They're wondering how the cryptocurrencies are going to affect all of this. And right now, this dark blue area, that just shows that most of the world's business is done in US dollars, and it seems to be doing okay for now. Here's an interesting chart. This is JP Morgan. No matter what comes out in Friday's session, they have 9 different scenarios of what they think will happen, depending on what is said in the employment situation report. I'm not going to read these. Just if you want to pause this and look through it, it's just kind of interesting here. And then the S&P 500 year-to-date performance percent with and without the mega caps, where the S&P 500 with the mega caps, that's doing the best. If you take out NVIDIA, that drops it down. And if you take out the Magnificent Seven, it just shows the impact that the bigger stocks have had. And then JP Morgan, again, Citibank to July Fed rate cut bets ahead of jobs data. They still think that we're going to get a cut in July, even before the employment situation report comes out. Even though the market is looking at September as possibly being the first one, JP Morgan and Citi are still thinking that the Fed's going to come out in July with their first rate cut. And that could happen. It's not very probable right now, but they're still hanging on to that. Here's our intraday chart. Very slow day. Had a higher open, and we just danced along the unchanged level. We started to drift, came back up a little bit, came down to the daily pivot, bounced back up to the unchanged level, and that's pretty much where things ended. Here's our intraday chart. Not really anything significant here, and the futures are pretty much unchanged that I checked right before I started recording. We are seeing this, and this is positive. The blue line is still above the red line, where growth is outperforming value on the intraday chart. So not much of a change here with the growth to value ratio for the S&P intraday. And we were unchanged with growth, where we were down slightly with value for the large caps, down more with the mid caps, and down less with the small caps. So not seeing a real change here with small cap growth to value ratio, the mid cap growth to value ratio, or even the S&P growth to value ratio. Still looking okay here with our two different ETFs, where we're above the rainbow and continuing to go up. But not seeing really much of a change here when we look at discretionary versus staples. Large cap growth was barely up. It was up 0.01%, but still coming off of setting a recent all-time high. The Wilshire was down slightly after also setting an all-time high. Our trend, we're still showing the ADX going lower, but the green line is on top. Also seeing that in the short-term chart here. Volume continues to drop off. Sentiment not really changing all that much according to the Ulcer Index. We did get a reading a couple of days ago at 3.16 for the Investors Intelligence. That's above 3. Little bit of a tick down on a closing basis with the VIX when we look at the line chart and the bar chart. And the volatility of the VIX is actually picking up just a little bit. There might be some maneuvering going on ahead of the report coming out. The momentum for the VIX is still higher, but we're rolling over with the MACD now. And we tick down here with the equity put call ratio. So now where the equity put call ratio had been going up, now it's going back down, which tends to be more positive. The volatility risk premium ticked down just a little bit, but we're still above this band area. We ticked up a little bit with this fear gauge and ticked down a little bit with this other fear gauge. So the market just is not, they're in wait and see mode right now. We did get the latest reading of the American Association of Individual Investors, where they came down a little bit. They're still coming in at 7, but the moving average continues to go higher. And a little bit of a tick down with the advanced decline line based on price, where we're pretty much flat based on volume. And we did see some new highs being set and a contraction of the new lows. We're starting to turn back up with the 5 period, but we're still declining with the 10 period. We're still barely above 0 here with the advanced decline ratio, both in the short and intermediate term. This is still looking positive. The accumulation distribution continues to go up and is above the advancing moving average. The chicken money flow fell a little bit, but we are still going up overall. The chicken oscillators crossing above this red line. Now it could still go higher, but there have been times when we hit this level and that marked kind of a top, at least for the indicator. We didn't see much of a change here with the NYSE cumulative advanced decline line. It was up slightly and barely a tick up with our regular advanced decline line. Also a bit of a tick up with our other NYSE advanced decline line. Little movement with NYSE common stock, a little bit more of an upward move when we base this on volume. And that could be taken as positive. We are still seeing volume outperforming price. Also, when we look here at the cumulative S&P, based on price, not much of a difference. We're actually breaking out based on volume. And the advanced decline lines are holding up for right now. All of them are above their moving averages, even though they declined slightly in Thursday's session. Here is the daily chart. Really not much going on other than we even dropped further below average with volume. Here's the Williams percent R. Now, this is just a daily chart, and it's a very touchy indicator. The CCI 14 and the CCI 20 continue to be extreme positive. We're still extreme positive with the short-term stochastic. We're crossing back positive in the intermediate term and turning back up, and still extreme with the long short-term stochastic. Still above the green and blue line here with our double and triple exponential moving average studies based on 20 periods. This is still showing more positive action in the short term. Not really much of a change, but a slight decline with the 20. We were flat with the 50 and flat with the 200 period moving averages. The force index declined a little bit, but it's still positive. We're still above the regular 20 period moving averages. We're still in the +2 channel with our standard deviations chart. The balance of power is still right around that. In fact, it's right at 0 again. It's pretty much non-committed. We're still positive with the go, no-go system with the darker blue bars. We're still up at the blue line here with our highest high value. The TTM squeeze is still declining, but it seems to be slowing in its decline a bit. We're still above the 50 period moving averages here with our double and triple exponential moving average study. So that's holding up. And here's the 50 period moving averages. We want to keep an eye on those. The ease of movement continues to be positive. The Erin is still positive. This is where we're seeing some weakness. The McClellan oscillator for the S&P is still below 0, and it declined on Thursday. So the summation index is declining. But when we look at this based on price, we could be starting to level out here. So that it could switch over to positive if we have a good up day. But for right now, it's negative because both of these continue to decline. And we're also below 0 with the NYSE McClellan oscillator. So we're declining with the summation index based on price and volume. We're turning back positive and holding on to the gains that we've seen here with the Swenlin trading oscillator. We're above 0 based on price and actually came up a little bit based on volume. The momentum oscillators, they're kind of mixed up right now. The PMO came back down to its moving average. It's trying to turn up, but we're still declining based on price and volume. Really no change with the PMOs that are rising, seeing a little bit of an improvement with the buy signals, and we're still declining with the PMOs that are above 0. We continue to be positive with the Elder's Impulse system for the S&P. We're back to positive for the second day now with the parabolic SAR. This is what I consider to be a primary signal. The slope oscillator rolling up a little bit, but still declining. The MACD is actually crossing back above its moving average. So we're looking mixed with our momentum oscillators. We're still declining with the slope. The TSI is turning back above its moving average. The MACD, as I just pointed out, is going back above its moving average. The PMOs showing a little bit of improvement. The PPOs right on top of its moving average. We're still on the moving averages when we look at the TRIX and KST. Still above all the plotted moving averages that we follow. We did go up with a bullish percent index and we're above 50, so that's positive. And little change with the NYSE bullish percent index. We are still negative with the NASDAQ 100 bullish percent index, even though it did go up, it's below 50. Still looking okay with the money flow, looking positive with the ultimate oscillator, still looking positive with the vortex. Really little change with the RSI 14 and 9, showing good momentum since they are both above 50. We ticked down a little bit with the down day for on-balance volume. And we're still below 50 with the stocks inside the S&P above their 20-day moving averages. So we're just wondering what's going to happen going forward here. We saw that initial upward thrust, and then we've been pulling back. Are we going to see more follow-through on a short-term basis? We're right under 50. We're at 49 right now with stocks above their 50-day moving averages. We ticked down, but still above 50 with stocks above their 100 period moving average, and we're still declining with stocks above their 200-day moving averages. The Copic curve is negative. The Sean trend meter is now getting extreme positive. Don't have any support or resistance now. The market's just really indecisive. On a trending basis, the Heiken Ashi is positive, the Kegi is positive, the Renko is positive, and the 3-line break is positive. We're still not looking extreme with our 150 moving average study. We're still barely extreme positive with the 200. And what looks like we are coming into a new cycle now that started on June 4th. Again, we'll have to see what that actually means. We do not have a confirmation signal with the Hindenburg-Ullman indicator, at least yet. We're still negative with the mid caps and the small caps in the short term, but everything else is positive. We're seeing some improvement with bonds in the short and intermediate term. We're still negative in the long term. Commodities are negative in the short term. The dollar is negative in both the short and intermediate term, and that could be giving support to stocks. No changes here on the decision point scorecard. Everything was blue or green as we saw some improvement with the S&P setting a new all-time high. Oil, which had been weak lately, crossed back above 75. The Dow got above 39,000. And most of the sectors were up, where we saw discretionary have the best day, then energy, healthcare. Healthcare is more defensive, just like staples. Utilities saw a bit more profit taking. The equal weight is showing that the big stocks are really outperforming as this ratio continues to go up. The Dow is right at this pivot point and just a little bit above its 50-day moving average. It was up 0.2%. The diamonds have turned back over to positive after being neutral for the last number of days. The NASDAQ was down slightly. Nothing really changed here. Same thing with the NASDAQ 100, just down slightly. The Qs still remain positive for the Elders Impulse system. The momentum for the NASDAQ 100 is looking a little more positive. We're trying to cross back above the moving average. Still looking solid here with the Qs above all the plotted moving averages here. Small caps were down, still finding support at their 50-day moving average, but not really showing any strength. And they've gone, this looks like a machine gun here, where you have it negative, positive, negative, positive. Well, we were positive. Now we switch back to negative for the small caps when looking at the Elders Impulse system. And we're a little bit below the 50 level when we look at the Russell 2000 small caps and the RSI. We're still above the 50-day moving average, but the momentum continues to be negative. The mid caps also kind of chopping sideways right now, still underneath their 50-day moving average. They continue to be neutral with the Elders Impulse system. Apple was down slightly, but still above both of the moving averages. Tesla was up a little bit above its moving average, but still in a downtrend. NVIDIA saw a little bit of profit taking, but still the strongest stock there is right now and what everybody's talking about. Microsoft is a little bit further above its 50-day moving average and still in a solid uptrend. Meta was down slightly, but still above its 50-day moving average and in an uptrend. Amazon was up over 2%, finally able to climb back above its 50-day moving average. Google was up as well and also looking fairly strong. Netflix was down slightly, but still also in an uptrend. The FANG index was virtually unchanged, down slightly after setting a new closing all-time high. The financial sector was virtually unchanged, right at its 50-day moving average. We did see a bit of a decline with our staples to tech ratio, and that's what we want to see if we're going to be more positive. The dollar shows it up here, but was actually down slightly as we're getting into the low 104 range. Not really, well, we're turning down a little bit when we look at the S&P and compare it on a short-term basis to the world index that we follow. Longer term, we're just going flat sideways here. Staples were up slightly, still in an uptrend, still a defensive area that we're keeping an eye on. Utilities saw a little bit more profit taking, but still have been doing quite well. Healthcare was up, also another defensive area that we're keeping an eye on. Energy was up 0.5%, a little more than that, but it has been seeing some weakness under its 50-day moving average, coming off of setting a recent all-time high with the total U.S. stock ETF. We continue to decline with the 10-year yield, and that's giving support to stocks where we're going up with the 10-year based on price. Seeing a little bit of an improvement here with the Qs to S&P, even though it ticked down a little bit. This has been showing improvement over the last couple of sessions. Still looking strong, still looking weak with discretionary to the S&P, but it ticked up slightly. Large cap growth is holding up when compared to large cap value. So with the large caps, we're seeing an improvement coming back up to a declining moving average with the mid caps and slightly above the moving average with the small caps. Still not seeing much of a change here with our 10-day average of the S&P 500 highs minus the lows. To turn more positive, we want this to go back up and stay up here like it has for most of 2024. And this is showing a little bit more improvement too. We're above zero based on price with our 19-day advanced decline ratio. We're seeing more of an improvement here based on volume, and that could be encouraging. The S&P to utilities ratio is ticking back up slightly, but we want to see more follow through to turn more positive for the S&P. And this ratio between staples and the S&P ticked down slightly. We want that to continue to decline. So the outlook, we're still positive, and strength has been re-entering the market, and we're holding up. We're not really seeing any selling right now. But Friday is its own day, and the market's really setting itself up to react to that. This weakness that we're keeping an eye on, like the McClellan oscillators and the summation indexes, to me, those are big deals. They can get rectified and turn over positive, but for right now, we just want to be aware of them. We do have positive seasonality when we look at this during an election year. We're going to get the employment situation report, wholesale inventories, and consumer credit. We want to keep an eye on all the different geopolitical events. Here is the finish of the economic calendar for the week, also highlighting what they're expecting will be coming out. Seasonality, where we just go over the last 20 years, we're across the board. We're positive with the Dow, we're negative with the S&P, we're neutral to negative with the NASDAQ. Friday is a pretty positive day, not as positive as Monday, but it's the second best performing day of the week compared to what happened in 2023. This is where we see more positive seasonality during an election year. We have a couple days left of the green dashed line still going up. We also see longer term, as we get further into June, we do see positive seasonality during an election year. If you monkey around with the numbers enough and take out 2020 like it didn't count, where when you look at the NASDAQ, we see things choppy a little bit more through June and July, where it's more into August, where we start to see more strength with the NASDAQ. We're coming into the negative period now, according to Tom Bowley's research. We've passed the 6th, we're going into the 7th, where this could suggest, according to his research, that we might see some pullbacks. So the warning signs, we are still keeping in the back of our mind that the S&P set a new all-time high a week or two back, with staples and utilities being strong. And this is a defensive play, and this is now it's becoming less and less relevant, but we still want to keep this in mind because staples and utilities are hanging in there now. We're also watching energy and also another defensive area, healthcare. The growth to value and discretionary to staples ratios, they're just not leading, and it's been that way now for a few days. The S&P and NYSE McClellan oscillators, as well as the summation indexes, are negative. Our oscillators are turning negative, but we could be seeing a bit of a turn back up in the short and intermediate term. The Copic curve is negative. We're still below 50 with the 20 and 50 period moving average studies. The bullish percent index for the NASDAQ 100, it did come up, but it's still negative. And then I didn't make that little graphic go away. But I did change this to make it look a little better here. These are the positive things. Now the equity put-call ratio is going back down, which is positive. We're still above the moving averages with the advanced decline lines. The parabolic SAR is positive. The Swenlin trading oscillator is positive. And the darker kind of goldish color, that means they're a primary indicator. Yellow means they're a low primary, high secondary indicator, in my opinion. And then the reason I have this bracket on here is I tend to take the three of these, and I changed this. I really did, but it didn't shift over here. The accumulation distribution, Chaikin money flow, and Chaikin oscillator, I treat those as one unit, where the bullish percent index is above 50 and now climbing. I really did change that. We have the money flow and the ultimate oscillator are positive. The vortex in the financial sector is positive, and we're looking a little better with the momentum of the NASDAQ 100. So our conclusion, we're positive. This has not changed. Strength is re-entering the market. Can it continue? Or are we going to see some weakness coming in? But these weaker areas are still a concern to us, and we do have positive seasonality. That's what we're looking at in the short term, intermediate term as well. We're still positive in the long term. Thank you. I hope you found this helpful. I really hope that you have a great day. We'll be waiting to see what happens with the employment situation and then how the market reacts to that. So have a great day, and I will talk to you in the next video.